Hello students, the topic which we are going to discuss today, that is financial instruments. It is one of the important topic which is supposed to be tested by the examiner in your paper financial reporting. But keep in mind that we have a lot of standards relevant to this, but they are not fully tested. So in my today's lecture, I'm focused on how financial instruments are going to be tested in paper financial reporting. So what is the expected accomplishments of today's session? We will talk about what are the relevant standards about financial instruments. Then we will talk about important definitions. Then what is financial liabilities and how to account for financial liabilities. Then classification of preference share, whether it is a liability or it is equity. Then we will talk about compound instruments, like the instruments those have characteristics of financial liability as well as equity, how to account for those financial instruments. Then we will talk about what is financial assets and how they will recognize and accounted in your financial statements. Then we will talk about whether we can do the offsettings or not. Then what is the derecognition criteria for financial assets and liabilities. Then we will talk about factoring of receivables, and finally we will discuss disclosures and some exam questions. So this is a very comprehensive topic and we will discuss this topic in one sitting. First of all, relevant standards. First of all, IAS 32, financial instruments presentation, is a relevant standard. We will talk about this standard. Then we will talk about IFRS 7, which is financial instruments disclosures. And then IFRS 9, which is about financial instruments. But keep in mind that all these standards are not 100% examinable in your paper financial reporting. Again, I'm repeating, in my today's session, I will focus on how these standards will be tested by the examiner in paper financial reporting. So first of all, about key definitions. Number one, financial instruments. A financial instrument is any contract that gives rise to a financial asset of one entity and a financial liability or equity instruments of another entity. So this definition have three components. First of all, it is a contract. We already have discussed in so many lectures. What is a contract? It is a written agreement between two parties. But which contract that gives rise to what? Financial asset for one party and financial liability or equity instrument for another party. So the thing is, this is a contract. The result of that contract, one party will get financial asset and other party have either financial liability, either equity instrument of another entity. Now, what is financial asset? Is any asset. So it means when we are talking about financial asset, it must have to fulfill the criteria for what the criteria we have, recognition criteria for any asset. So it is an asset in the form of cash. If you have cash, that is your financial asset. If it is a contractual right, and in that right you will receive cash, due to that contract you will receive cash in future or any other financial asset from another entity. So that will give the right to receive a cash in future or any other financial asset from any other entity. A contractual right, again, there is a possibility that it would be a contractual right to exchange financial assets or liability with another entity, under conditions that are potentially favorable. So it is a contractual right or exchange of financial assets or liability with an other entity in which you are getting favorable terms. So if you are getting favorable terms in your contractual right, it is called again financial asset. And you have right to get equity instrument of another entity. So in all these cases, you have financial asset. Then financial liability. It is a contractual obligation. You are familiar that if one party will get the right of asset, the other party have some obligation. So if you have a contractual obligation to deliver cash, for what? To deliver cash or another financial asset to another entity, it is your financial liability. Or to exchange financial asset or liability with another entity, which is potentially unfavorable. For financial asset, it must have a favorable exchange terms, but under financial liabilities, you have unfavorable exchange terms. Then there is another possibility that will or may be settled in entities' own equity instruments. So you may settle that liability in your own equity instruments. It means you will issue your own equity instruments to settle that liability. Okay. So in these cases, this is financial liability. Then equity instrument. Any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. Simple. We have accounting equation. Which is assets equals to liabilities plus equity. So when we will subtract your liabilities from your assets, so assets minus liability, this is what you have residual interest. So equity is what? Equity is residual interest, means after deducting all liabilities from the assets of an entity, remaining thing is equity. And if that contract gives rise to that residual interest, we will talk that this is equity instrument. If it is a result of a contract, and due to that result, you have residual interest in the assets of an other entity after deducting all its liabilities, you will say that it is equity instrument, which gives rise to your equity right in that entity. Okay. Then we have another definition, which is about compound instrument. It is a financial instrument. It is a financial instrument that have characteristics of both and liabilities, equity and liabilities. If any instrument have characteristics of both liability and equity, then we will say that this is convertible loan. It means there is a result of financial liability due to having that instrument, and there is a equity right as well as. So that is called compound instrument. Its example is convertible loan. Now, how to account for financial liabilities? First of all, we will look upon the initial recognition of financial liability. It is always initially recognized at its fair value. We have discussed in our previous lecture of how to, what is fair value, how to determine fair value under IFRS 13. Fair value. How we will calculate? Net proceeds. Net proceeds minus any issuance cost. Net proceeds means the proceeds after giving any discount minus any issuance cost. The figure which you will get, that is the result of this. The figure which you will get, that is your fair value. Okay. So this, you will initially recognize your financial liability at your fair value. Now, subsequent measurement. For the paper of financial reporting, your financial liabilities will be carried at amortized cost. This is important. There are some other possibilities we will discuss, but for paper financial reporting, we are supposed to deal with amortized cost. What is amortized cost? That is the initial value of your liability, which we have measured at initial recognition, which is fair value, plus effective interest we will add, minus interest paid. Remaining value is called amortized cost. Okay. Now, simple. Amortized cost is initial value plus effective interest minus interest paid. I will elaborate why effective rate is different from interest paid. The exception to this rule is financial liabilities held for trading and derivative liabilities. These both will be recognized fair value through profit and loss, not on amortized cost. But keep in mind, this is not in our syllabus. So we are supposed to do how initially financial liabilities will be recognized at fair value, subsequently will be recognized at what? Amortized cost. How amortized cost will be calculated? Initial value plus effective interest minus interest paid. I will elaborate shortly these two terms. What is effective interest rate and what is interest paid? Okay, effective interest rate. This can be different from nominal interest rate because there is a possibility that financial instrument may be issued at discount or redeemable at premium or having issuance cost. So the actual cost which organization is bearing, let's assume you have deep discounted bond, 5% deep discounted bond of $1,000. Okay. Now, its nominal rate is 5%. This is nominal rate. Okay. Now, these were issued, let's assume, at high discount and issued at 800. So, actual resources which you are getting by issuing these bonds is 800. Now, normally you will pay the interest on this percent, but when you will redeem, it will be redeemed at 1,000. Let's assume it's 2 years bond. So, at the end of year 1, you will pay 1,000 times 5% is equal to 50. At the end of year 2, 1,000 times 5% again 50. Now this 50 is interest paid, but actual cost is different because you are supposed to redeem at 1,000. It means you got 800 and you paid them 1,100. There is possibility that effective interest rate would be different from nominal rate. Okay. Now, how interest paid calculated? Interest payment is very simple calculated. Principal amount times nominal interest rate. And how interest expense calculated? Balance times effective interest rate. Now, keep in mind, for your exam point of view, in your paper financial reporting exam, you are not supposed to calculate your effective interest rate. It will always be given to you in your exam. Effective interest rate will always be given in FR exam, okay? So we are not supposed to calculate effective interest rate. It will be given to you in the question, okay? Then, next discussion is about how to classify preference shares. Their numericals we will discuss later on, how to calculate amortized cost. First of all, there is one possibility that you may have fixed payment. In that case, preference share will be classified. You have no fixed payment. In that case, preference share will be classified as equity. But if you have fixed payment, like you have redeemable preference shares of 5%, it means it has characteristic of debt and it will be considered as your financial liability. It is your financial liability when you have fixed payment. If against preference share you don't have fixed payment, it will be classified as equity. But if you have fixed payment, then it will be classified as debt, which is your financial liability. Then how to classify interest and dividend? Its classification will depend upon the classification of underlying financial instrument. If your financial instrument is classified as debt, your interest will be finance cost. It would be interest. Let's assume for debt instruments, it's very clear. It is finance cost in your statement of profit and loss. But if you have preference here, over there, its classification will depend. If it is classified as financial liability, then your relevant dividend is your finance cost in your statement of profit and loss. But if preference shares are classified as equity, then your dividend is in equity section, okay? Now, compound instruments. Its example is convertible loan note, whose have following characteristics. It is repayable at lender's option. So it is about lender's discretionary authority when he can repay in the form of issuance of shares company instead of cash. He can opt to buy the shares of the company instead of reclaiming the cash. Then how many numbers of shares you are supposed to issue? These are fixed at the time when loan is given. Say you have issued loan note of 1,000 which is convertible. You may have given the option, say one share for $500. It means for 1,000 you have predetermined fixed number of shares, which is 2. Then due to the result of this, because the risk of default of lender is less, he will accept. Normally they are issued at interest rate which is below than the market rate for non-convertible instruments, okay? Then how these compound instruments are accounted for? These are accounted for using split account. What is split accounting? That you will segregate it into liability and debt element. Because there is a obligation to deliver cash For the issuer, the person who got the loan, there is a financial liability as well as element of equity, as the investor have the right to convert the loan into shareholders. So compound instrument have both characteristics of debt instruments and equity instruments. So in that case, you will use what? Split accounting to bifurcate it between debt and equity. So first of all, compound instruments initial recognition, how they will initially recognize. First of all, you will calculate debt or liabilities section, which is at fair value. That is the present value of future cash flows of principal and interest. So two types of cash flows you have. You are supposed to make the payment of principal at the end of the term period of loan, and you are supposed to make interest payments. You will calculate the present value of future cash flows. That would be your debt or liability portion, and residual figure would be your equity portion, which is your total loan proceed, how much loan you have, minus debt value, which we have calculated here. This result will be subtracted from loan proceeds. The figure which you will get, that would be your debt equity value. Then compound instruments, subsequent measurement. The debt portion will be measured using amortized cost method, which we have discussed, initial value plus effective interest minus interest paid, and your equity section will never be changed because it is not remeasured. So equity section value will be same, which we have calculated at initial, but that section will be measured at amortized cost, which we have already determined for that set. Then we will talk about financial assets. Their initial recognition in your statement of financial position will be when and only when the party will become part of the contract. When your party will become part of the contract, then you will recognize your financial assets in your financial statements. And it would be at fair value, which we will calculate purchase consideration plus transaction cost. And exception to this rule is this: if you are using fair value through statement of profit and loss, then transaction cost will never be capitalized. I will talk about later on about these classifications. If you have fair value through SPL, in that case, transaction cost will not be capitalized. Otherwise, it would be part of fair value. In that case, your fair value would be only your purchase consideration if you have FV through SPL. Now, if your financial asset, you have investment in equity instruments, you have these possibilities. You can either classify your recognize your financial asset as at FV through P and L, FVPL, which is default category. And under this category, your transaction cost will never be capitalized. That would be expensed out. We'll talk about later on. The other possibility, which is that is fair value through other comprehensive income. So your default category is fair value through P and L, and your other category is fair value through other comprehensive income. We will talk about later on. Now, first of all, fair value through profit and loss. When investment capitalized at purchase consideration, no transaction cost. Transaction cost will be expensed in your statement of profit and loss. Investment will be revalued at the end of the each accounting period, and any gain or loss on revaluation will be shown in your statement of profit and loss. So what is initial measurement? Only at investment, at purchase consideration, it will be capitalized. Transaction cost will be expense. Later on, it will be revalued at end of the each accounting period, and if you have any gain or loss, it would be expensed out in your statement of profit and loss. Keep in mind, this is your default category. If there is no indication for any other category, you will recognize your financial asset. If your investment is in equity instrument, you will recognize it in your fair value through P&L. There is another possibility, that fair value through OCI. First of all, if you are opting fair value through OCI, keep in mind default is fair value through profit and loss. You will recognize fair value through OCI at your point of acquisition. When it can be done, if you have intent to hold investment for the long-term period, in that case, you can shift from your default category to this category. If you have invested in equity instruments, then transaction cost also capitalized along with purchase consideration. Here under fair value through P&L, you will expense out your transaction cost, but here you will capitalize. Investment will be revalued at the end of each accounting period like that, and any gain or loss on revaluation will be charged through equity section. So if you are holding financial asset by having investment in equity instrument of another organization, you have two possibilities: fair value through profit and loss, and the other possibility is fair value through OCI. Default category is fair value through profit and loss. It will be only charged when you have intent to hold your investment for a long-term period. Then we have another category, which is if we have investment in debt instruments. Over there, we have three possibilities. If we have financial asset, which is an investment in another entity's debt instruments, then we have fair value through P&L, fair value through OCI, and amortized cost. For equity instruments, we have only two classifications: fair value through P&L and fair value through OCI. But here we have three classifications. Again, here default category is fair value through profit and loss. So other two categories adoption will depend upon one model we will discuss later on. This is dependent upon two tests. That is the model. One is business model test and contractual cash flows characteristic test. If these conditions will be met, then we will either classify fair value through OCI or amortized cost. But your default category again here is fair value through P&L. Now, fair value through P&L, investment capitalized at purchase consideration, transaction cost will be expensed. We have already determined. Investment will be revalued at the end of each accounting period. If there is any gain or loss, it will be charged through statement of profit and loss. But if you have Amortized cost category. Here, first of all, you will check business model test. If you have intent to hold the investment till maturity, then you have business model test. Contractual terms of financial asset may give rise to cash flows that are solely of principal and interest. You have intent to hold the investment till the maturity of in your debt instruments, and your contract will give you the two rights to receive principal and interest. If you have any other right, in that case business model test will not be applicable. I am giving you the indication. If you have compound instrument, in that case you have an other contract is giving you the right to convert your debts into equities. In that case business model test is not fully applicable and you can't recognize it on your amortized cost. If your due to the contract you have only two rights of cash flows, which is against principal, you are supposed to receive your principal amount and interest. In that case business test is okay. So if both tests will be okay, in that case you will recognize your debt instrument at amortized cost. Again, we will calculate the value of investment using amortized cost table. Any interest income which we will receive, that will be charged in statement of profit and loss. Then fair value through OCI. First one, business model test. Here you have intent to hold till maturity, but there is a possibility that you may sell that asset to buy another asset which will give you higher return. So this section afterward, this is additional thing. If you have this intent that normally you want to hold that till maturity, but you have intent that if you will get another asset which will give you the higher return, you will sell this asset and you will buy another asset. In that case, business model test will guide you to classify it fair value through OCI. Then contractual cash flows test. Sorry, this is typo mistake. This is contractual cash flows test. In that case, the contractual terms of financial assets may give rise to cash flows. Those are solely of principal and interest. Again, your cash flows are solely principal and interest. In that case, transaction costs also capitalized along with your purchase consideration, and interest income will be shown in SPL. But investment once revalued at the end of each accounting period, interest will be shown in statement of profit and loss, but gain or loss on revaluation will be shown in OCI. Then we have discussion about offsettings. There is very limited circumstance in that where your financial assets and financial liabilities will be offsetted. There is only possibility that you may offset when it is legally enforceable right to set off the amount. You have legal enforceable right to set off the amount, and you have intent either to settle your financial asset or liability on that basis, or to realize the asset and settle the liability simultaneously. Either you have to settle on that basis or to realize it. You will sell your asset and pay your liability in that case. But if it is legally allowed to you, in that case you can do the offsetting, otherwise it is not allowed. Then derecognition. Financial assets will be de-recognized from your financial statements only and only when your financial asset expires. Okay. Then financial liability will be de-recognized when it is discharged, you have paid, there is a cancellation of the contract, or your financial liability time period is expired. In that case, you will de-recognize. The gain and loss at de-recognition point of time will be charged to statement of profit and loss. Then we have discussion about factoring of receivables. First of all, what is factoring? This is the arrangement in which company is transferring its receivable to another company for what? Three purposes. For management of receivables, for collection of receivables, and received in advance on the value of these receivables. You will get the amount in advance and you will allow that company to collect on your behalf from your client, and they will manage your receivables. This is called factoring. Then what is the key question? Key question is, are you have actually sold your receivables? This is important point. Here, what is the criteria? Whether the loan which you have received in advance will be treated as your loan, or it will be treated as sale of your receivables. Key factor is whether risk is transferred to them or not. Who is bearing the risk of default from the client and slow payments? Now, there are two types of arrangements. There are two types of arrangements. Number one, first arrangement is sale with recourse, and then second one is sale without recourse. If you have sale with recourse, in that case, factor have right to return any unpaid debt. It means risk will remain with you. You are bearing the risk of default. In that case, your sale will not be, it is not your sale, but the amount which you have got, that will be treated as loan against the security of receivables. But if the risk of default transferred to the factor, in that case, it will be treated as sale and receivables are removed from the entity's financial statements. Clear? Now, if it is sale with recourse, in that case, the amount will be treated as your loan. But if sale without recourse, in that case, amount will be treated as your sale, and you will de-recognize your receivables from your financial statements. Now, what are the relevant disclosures? Carrying amount of each class of your financial instruments should be recorded either on the face of statement of financial position or within the notes. So carrying amount you can show on your SFP face or in your notes. There is also requirement that you must have to disclose any income, expense, gain or loss for each class of financial instrument, either in statement of profit and loss or in OCI, because or within the notes. Because if you have state fair value through OCI, in that case it will gain and loss will go to OCI. So you can show either on your statement of profit and loss face, on your OCI face, or in your notes. You must have to make the disclosures regarding nature and extent of risk faced by the entity. How much risk you are bearing, what is the management objectives and policies of managing those risks, and any changes in the year. So about your risk management policy for your financial instruments, you have to disclose in your financial statements. Now let's start some exam questions. Viking issues $100,000 5% loan note on 1st January 2004, incurring issue cost of $3,000. These loan notes are redeemable at a premium, meaning that the effective rate of interest is 8% per annum. What is the finance cost to be shown in statement of profit and loss for the year ended 31st December 2005? Now, what's the question? Question is that Viking issues 100,000 5% loan notes. Now your loan notes amount is 100,000 and nominal interest rate is 5%. And these loan notes are redeemable at premium, which gives you the effective interest rate of 8%. This is different from the nominal interest rate. Now your finance cost, interest expense, we have discussed that its method is your balance times effective interest rate. That is expense figure. So effective interest rate is how much? It is 8%. Okay. Now your net proceeds balance is 100,000 minus issuance cost, which is 3,000. So times effective interest rate, which is 8%. So 97,000 times 8% is equal to 7760. This is your answer. Now next is an entity issued 3,000 convertible bonds at start of year 1. This is compound instrument, convertible bond. They have a 3 years term and a face value of $1,000 per bond. Interest is payable annually in arrear at 7% per annum. Each bond is convertible at any time up to maturity into 250 common shares. So it is compound instrument. When the bond are issued, the prevailing market interest rate for similar debts without conversion option is 9%. This is effective rate. So the interest rate, which is without, because we have already discussed that your compound instruments have characteristic over there, your interest rate is lower. So this is your effective interest rate. And these are relevant discount factors. So he is asking about to bifurcate between debt and equity. For debt portion, we have to calculate present value of cash flows, which we have determined two types, principal and interest. For year 1, we have interest of how much? 3,000 times 1,000 par value, total figure is 3 million. And interest is paid at 7% times 0.07. So rule of thumb is cash flow is 210,000 in the form of interest. Keep in mind, in this type of questions, rule of thumb, to remember the things, you will calculate the interest cash flow by multiplying with lower interest rate, and discount factor you will use for higher interest rate, which is 9%, which is effective rate, times 9%, discount factor is 0.914. So times 0.914 is equal to 191940. For year 2, again our interest figure is 210,000 times 0.837, sorry. So year 2, 210,000 times 0.837 equals to 175,770 for year 3. Now 210 is interest as well as principal of 3 million. So 210 times 0.766 160,860. Then in year 3 again we have principal of how much? 3 million times 0.766. Now 3 million times 0.766 is equal to 2298,000. Now we will sum up of these figures, which is our debt portion plus 160,860 plus 175,770 plus 191940. So it is 2826570. 2826570. Now this is debt element, so our answer is B, but we will calculate equity element. Equity element is initial cash proceeds, which is 3 million, minus debt portion 2826510 minus 3 million, it is equal to 173,430. 173,430. So our answer is counter verified B. But without calculating equity element, because that element, the answer which we have calculated, that is the only this figure. So our answer is B. Now, for a debt investment to be held under amortized cost, it must pass two tests. What are those two tests? One of these is contractual cash flow. The other is which one? Business model test. So our answer is option A. Then we have another question. What is the default classification for an equity instrument? That is either equity instruments, investments, or equity debt investments, that is fair value through P&L. So our answer is A. Answer is A. Okay. Not amortized fair value through OCI and net proceeds, never. Our answer is fair value through P&L. Then we have another exam question. ABC purchased 10,000 shares on 1st September 2024, making the election to use the alternative treatment under IFRS 9 financial instruments. Now it is equity instrument and you have alternative treatment. What is alternative treatment? That is fair value through OCI. Share cost 3.50, transaction. The share cost $3.5 each, transaction cost associated with the purchase were $500. Now keep in mind, this is equity instruments investment and you are using alternative treatment, which is fair value through OCI. At 31st December 2024, the shares are trading at $4.5 each. Now keep in mind, For initial recognition under fair value through OCI, you will capitalize your transaction cost. Now it is 10,000 times 3.5 equals to 35,000 plus 500 equals to 35,500. This is initial recognition. At the year end, it is traded at 4.5 each. So 10,000 times 4.5 equals to 45,000. Now, the carrying value at the end of accounting period is higher than the value at initial recognition. Now, difference is gain, which is difference of these two figures, that is 45,000 minus 35,500 equals to 9,500. So that is our answer. The question is, if it would be a fair value through P&L, then that 500 will never be capitalized, but it is alternative treatment. Okay. Now, exam question is, DEF purchased 15,000 shares in KMH company on 1st August 2006 at a cost of $6.5 each. Transaction cost on the purchase amount to $1,500. At the year end, 30th September 2006, these shares are now worth 7.75. Now, here is no indication whether it is default treatment or alternative. In that case, we will go through default, which is fair value through P&L. In that case, transaction cost will be treated as an expense. So your value is 15,000 times 6.5 at initial recognition. Transaction cost will never be capitalized. So 15,000 times 6.5 is equal to 97,500. Now at the end, it is 15,000 times 7.75. So 15,000 times 7.75 equals to 116,250. The difference is minus 97,500 is 18,750, which we can calculate by alternative way. Like the difference between 7.75 and 6.5 is equal to 1.25 times 15,000. So 15,000 times 1.25, 18,750. Now, it is gain 18,750, where it will be treated statement of profit and loss, SPL, not statement of other comprehensive. It is fair value through SPL. Okay. Now, next question is, for which category of financial instruments are transaction cost excluded from initial value? We know, and instead expense to fair profit and loss, fair value through profit and loss, financial asset at fair value through profit and loss. Option B is the answer. Now, next question is, for each of the financial instruments below, match them to the appropriate accounting treatment. Convertible loan notes, subject accounting, okay, because it's a compound instrument. Equity investment, where the entity has the intention to hold long term and has chosen to apply the alternative treatment, that is fair value through OCI, because it is equity instrument which you want to hold long term. Okay, then financial liability not held for trading, it is through amortized cost. Then equity investment under default position. Default position is always fair value through P&L. Okay. Now, this is the scenario. In section A, first part of the scenario, on 1st September 2003, Laidlaw factored sold $2 million of trade receivables to the Finney's. Laidlaw received an immediate payment of $1.8 million. Under the factoring agreement, any receivable not collected after 4 months will be sold back to Laidlaw. This is factoring with recourse. Factoring with recourse. Okay. When you have factoring with recourse, it will be considered as loan, not your sales, because risk still you are having of irrecoverable debts and slow payment. Okay. Then on 1st October 2002, Laidlaw sold some maturing inventory which had a cost of 4.5 million to a bank for its fair value of 5 million. Under the terms of the sale agreement, Laidlaw has the option to repurchase the inventory. This is important. You are repurchasing that inventory. It means risk and rewards associated with purchase of that inventory belongs to you. After a period of 10 years at a price of 7.4 million, at that date, the fair value of the inventory is expected to be 11 million and the repurchase price reflect an equivalent annual rate of interest of 4%. So this is again, you have repurchase, risk and reward associated. If price will go down, you are responsible. If price will go up as you are expecting, again, you are entitled. Again, your sale will not be deemed. This is also your loan. That is important thing. In third case, Laidlaw issued $10 million convertible loan notes on October 20x2 that carry a nominal coupon interest rate of 5% and are redeemable on 1st October 2005. A similar loan note without conversion option would have required Laidlaw to pay an interest rate of 8%. This is effective rate. And this is 5% is your nominal rate. Okay. Now, discount rates are given for all time periods. We will use discount rates of effective rate. Now, first, now move towards first question, which is which of the following is correct regarding Laidlaw's factoring of trade receivables for the year ended 30th September 2003? The receipt of 1.8 million should be treated as a loan. Yes, we have already established, so our answer is D. It is our loan. Now move to the next question. Which amount should be recorded in equity in respect of the convertible loan notes issued by the Laidlaw? Now let's move towards the question. How much loan amount is 10 million and it is on 1st October 2003 that carry a nominal interest rate and are redeemable on 1st October 2005. Issued on 1st October 2002. Now, till 2003, 1, 2004, 2, and 2005, 3 years. It's a loan for 3 years time period. Now 10 million is the amount and nominal rate is 5% and discounted rate is 8%. Now your interest of year 1 is 10 million times 0.05%. It is equal to 500,000. For year 2, it is again 500,000. These are our cash flows. For year 3, it is again 500,000 and 10 million principal amount. This is interest portion, this is principal. Times discount factor at 8%, which is effective rate. So let's check the discount factor, which is okay, at the end of on 0.93, 0.86 and 0.79. 0.93, 0.93, 0.86 and 0.7. Let's check again. 0.86, 0.79. It is 0.79 and again for this 0.79. Now 500,000 times 0.93, 465,000. Then 500,000 times 0.86, 430,000. 500,000 times 0.79, 395,000. Then 10 million times 0.79, 7.9 million. So total is plus 395,000 plus 430,000 plus 465,000 equals to 9190,000. This is debt portion. Now question is equity. So from principal amount, which is 10 million, we will subtract this amount 9190,000. The balancing figure is equity. Equals to 810. Now this is your equity figure, 810,000. Now, which two of the following items should be recorded in Ledla's financial statement for the year ended 30th September 2003 in respect of maturing inventory? We have already established it's a loan. So our answer is 5.2 million. Which is 5.2 million loan. Loan is 5 point which two of the following items should be recorded in Ledlaw financial statements for the year ended 30th September 2003 in respect of the maturing inventory sales? we have already established that maturing inventory sales is a loan. You can't recognize it as being your sales. So in that case, uh, the value is, the original value of loan is 5 million. That is your loan plus 5 million times effective rate was 4%. For 5 million times 4% is equal to 200,000. That is your finance cost. So option A is the right answer. And your value of loan, now that 200 is also payable, that is 5.2 million. So option A and option D are the right answer. Then which of the following statements regarding convertible loan notes is not true? Now, which one is not true? Convertible loan notes will affect gearing due to the liability component being different to the equity component. Yes, both are different. The equity amount will remain fixed until the date of conversion. Yes, this is also correct. The liability at 30th September 2005 will be 10 million and 5% interest will be charged to the statement of profit and loss as finance cost. No, it's 8%. Liability at 30th September 2025 will be 10 million, equal to the amount of what? Principal. 5% interest will be charged. No, it is 8%. Interest rate would be 8%. Finance cost will be charged at effective interest rate. So this is not true. Then we have another question. Applying the principle of split accounting to convertible loan notes is important to satisfy which of the following qualitative characteristics? Faithful representation, timeliness, verifiability, and relevance. When we are splitting the component between debt and equity, that is faithful representation. You are faithfully representing your debt portion and equity portion separately. You are not mixing them. So you are satisfying which qualitative characteristic? Faithful representation. Thank you very much, guys, for your time. This was all about financial instruments. I'm again emphasizing that this is one of the standard which is hot area by the examiner to test during your exams. Thank you very much.